Hello, everyone. Welcome to the Daniel Krug Associates tax review here in January 2025. My name is Rocky Istvan. I'm the Chief Compliance Officer and Associate Wealth Manager at Daniel Krug Associates. Just a reminder, this presentation is for education and illustrative purposes. So I'm excited to introduce Brenda Hunter, our CPA from Hunter CPA Group, to go over what's been going on in 2024 as you prepare for your taxes. See some highlights into what's coming up in 2025.
Thank you, Rocky. Hi, my name is Brenda Hunter, and I own a full-service tax and accounting service in downtown Oxford, Michigan. This is something that everybody's always interested in, is the tax brackets, which are still for 24 and 25 broken up into about 7 categories. And just people are always interested in what category they fall in. And just so you know, just because you fall in a tax bracket like 32%, you're still in a graduated tax bracket. So you're always going to start out with a percentage of your income in each part of the bracket. So a percentage of your income is going to be in the 10%, and then you're going to go up into the 12%, and then potentially the 22% and the 24%. So even though you may fall in one of the top brackets, you still have a graduated part of your income that is in all of the lower brackets. So not all of your income falls in that high bracket. It just, the top percentage of your income falls in that bracket. So while some people get very concerned about ending up in a higher bracket, just know that all of your income is not in that bracket, just the top percentage. And when we do your taxes, we always give you a comparison so you can see for the last couple of years what percentage you're in. Because you might, on your taxes to show you, you might actually be 17% or 23%. And what that is, it's telling you as a percentage-wise where your income falls. This is the dividend and capital gains rates for 2024. And like everybody, there is always a percentage that's 0%. It's not real high, but if you are in a low adjusted gross income, there is a percent that isn't actually taxable to you. But most people do fall in the 15% tax bracket. There's been a lot of chatter about getting rid of that and making everybody in the higher bracket or make it ordinary income. But it is still 15% for most people, unless you have a very low income, and then you may get a 0%. The standard deduction in 2024 for single filers is $14,600. For joint filers, it's $29,200. And at the bottom, it tells you the additional amount if you're over 65 or blind or disabled. These are the estate and trust rates, and the reason I show this each year is because I often have people who think it'd be much easier when filing a trust return is if we just have the trust pay the tax. But I just like to show people how quickly a trust goes into that 35 or 37% tax bracket. By the time the trust has $11,000 or $15,000 in taxable income, they're already in a 35 or a 37% tax bracket. If it's a revocable trust, generally the trust will say that the beneficiaries are supposed to pay the tax. And while it may seem simpler to have the trust pay the tax, and the trustee sometimes has the ability to say that, it is more beneficial to have the beneficiaries pay the tax. We can run it both ways and say, okay, this is what it cost for the individuals to pay the tax and have the trust reimburse the individuals. And that generally is a more cost-effective way to do it because, like I said, at these low amounts, it is better for the individuals to pay the tax. At the bottom, I have the gifting amounts. We get these calls a lot as well. The gifting amount in 24 was $18,000. In 25, it went up to $19,000. A lot of people get very confused about what gifting means. What that means is you can gift these amounts to anybody without having to report it. There is no tax or no deduction for gifting amounts. It just means you don't have to report it if it's under these amounts. If you do go over $18,000 in 2024, $19,000 in 2025, that just means you have to file a gift tax return. There is still no deduction. There is still no tax for either party. File a gift tax return and it comes off your exemption at death. The current amount for the lifetime exemption is 2024 was $13.61 million, and in 2025 it's roughly $13.92 million. So again, there was some chatter about making this amount come down. We have not heard if they are changing it, but currently it is staying the same. Last year, probably the number one thing that people came to see me about in appointments was planning for Social Security. So I added these 2 slides with the information that a lot of people asked me about. On the top part is simply the Social Security information. If you are still working, the rate has not changed for Social Security if you're still working in a very long time. The rate is 7.65%. The max wages you pay that amount is $168,600 was last year, and this year it's $176,100. The maximum earnings, if you decide to take Social Security at 62, between the age of 62 and 67, you are not considered full retirement age. So if you choose to work, you cannot earn more than $22,320 last year, and in 2025, it's $23,400. If you go over that amount, you have to pay back $1 for every $2 you go over that amount. Once you are 67, you are considered full retirement age, and you can earn as much money if you want if you decide to work. So a lot of people get confused about that. They think it's about taxability. It is not. It's just about earnings you can make. Your Social Security is considered income, and it can be taxable, but it's based on your other income. So roughly, if you're married and you make about $50,000, your Social Security is going to become taxable, and it can be up to 85% taxable. It just depends on your other income. The maximum Social Security benefit, that number is available through Social Security. The current number for 2025, if you choose to take it at age 62, is $2,831. Age 67 is $4,018, and age 70 is $5,108 per month. We encourage anybody to go on and set up an account with Social Security. Check and make sure all the years are correct. We do find people who, for whatever reason, a W-2 was never submitted for a year, and also to find out what their benefits are at any age. A lot of people have different philosophies over when they want to collect, and everyone's different. The other thing that people are always asking me is about Medicare rates. About 8 years ago, Social Security started charging Medicare rates based on your income. This is an area of contention for a lot of people, but just know a lot of things have happened. Obviously, medical expenses have gone up, and the amount being paid into Social Security is going down. So in an effort to combat this, they are charging more for Medicare if your income is higher. So what happens is it's a 2-year lag. So if you file your 2023 tax return in about November, you get a letter saying that your Medicare rate, or they may call it your IRMA, is going to be higher based on your adjusted gross income. They call it your MAGI. Based on that, your monthly Medicare is going to be higher. A lot of people get confused by these letters. They call me and say, my Social Security went down, or I don't understand. It is very confusing, but this is only generally a 2-year bump, and it can go down. There are times when you can get this changed. Social Security has 6 reasons why you can fill out a form and send it into Social Security and say, my income is high for one of these potential life-changing events. And those would be death of a spouse, divorce, I lost my job, I retired. But if your income was raised in a year for one of those reasons, they will look at it, they will consider it. You tell them what my income is going to be next year, and they may reduce it back to the lowest amount up there, which is considered the standard rate. They do not consider selling property. They do not consider Roth conversion to fall in one of those categories. Sometimes you have to look at it and decide, getting my income in a lower category going forward is worth raising my Medicare for a couple years. And so while it may seem like this is a bad thing, sometimes you have to weigh out the options of, my Medicare's higher for a couple years, but I'm going to do a Roth conversion, then I won't be paying the higher tax in future years as this income grows. So some people panic, and they really don't necessarily need to panic, Because in the scheme of things, while these rates may seem really high, medical insurance in general is going up for a lot of people. And like I said, after a couple of years, this will come back down. Net investment tax. So a lot of people see this on their tax return and they panic. They don't understand why they're paying this. There's a couple reasons why you may pay this on your tax return. One of the reasons might be if you have capital gains, interest, dividends, and it pushes your income over the income threshold. The other one would be as if your W-2 is high. The income thresholds are on the bottom of this slide, and that's single if it's over 200, married if it's over 250, and then estates and trust over 15,000. So this is an extra tax that was started about, again, maybe 10, 15 years ago, and it's to pay for the people that don't have health insurance. It's to cover the marketplace insurance. So these came 2 years ago, the energy improvement credits. These are way improved from what they used to be. They used to be $500 and they were minimum that once you used it, it was gone. Now it's a $1,200 annual limit and it renews every year. So you can do many things. You can get a home energy audit. You can get windows or doors, insulation. The only thing they did take away from this is roofing. Roofing no longer qualifies for this. The only thing I would tell you is you do have to make sure that it qualifies. So there's a spot on the IRS website where you can go and look up, or you can also look for anything that has the Energy Star rating generally qualifies for these credits. And a lot of times they will specifically, so say you're getting a water heater or a furnace or an air conditioner, generally the manufacturer or the person installing them will tell you they qualify. These are the electric car credits, and these have kind of been a pain, but originally they came out, they had good purpose, but now they've kind of turned into a nightmare. They started out, they were very simple, but now they have a lot of requirements on them. So I would definitely tell you, if you're interested in getting an electric car, definitely look it up, because now there's a lot of requirements. It has to have a specific battery, it has to have a specific critical mineral requirement, it has to be assembled in North America. A lot of these now can go directly through the dealer, and I would try to do that if you can, because then it comes off the price of the car. Starting in 2024, they started doing that. Retirement in 2024 and then going into 2025. So the IRAs slightly going up, 7,000 and 1,000 if you're over 50. You must have earned income to do an IRA. We get these calls all the time, and you cannot do an IRA if you don't have earned income or your spouse doesn't have earned income. And then a lot of people want to do Roth contribution. Your income has to be below a certain amount to do a Roth contribution. So if your income is too high to do an IRA, you can do a backdoor Roth. But if you're interested in that, you could contact me or Dan Krug's office, and they can help you with those. A new thing happened in 2024 where they started allowing 529 plans to convert to Roth IRAs. So a lot of people had leftover 529 plans. And what those are, if you don't know, those are education plans set up for kids to go to school. So they came up with this where you can convert that to a Roth IRA. There are a lot of rules. 529 must be open for at least 15 years. The beneficiary of the 529 must also be the beneficiary of the Roth IRA. The funds contributed to the 529 has to be 5 years before the rollover can be transferred. There's a cap on it of $35,000, and then the amount given each year cannot exceed. So each year you can only roll over the amount of the contribution amount that year, and then the amount completely is capped at $35,000. So there's a lot of rules on it, but if you're interested in doing that, it does give you something to do with these 529s, because if you take the money out of a 529 and don't use it for education, you get taxed on the money and penalized, unfortunately. So other rules for retirement, we still get these questions, but the age is staying at 73 for a while. So if you were not taking RMDs, that would be IRAs, SEPs, simple 401ks. The only exemption from that is if you have a 401k and you are still working. You can delay a 401k if you're still working until you retire. If you have an inherited IRA, you have to take RMDs. If the deceased person was taking RMDs, the only exemption from that is if you're under 18 or disabled. The other caveat of inherited IRAs is you must, unless you're the spouse, you have to clear that account out within 10 years. Roth IRA owners do not have to take RMDs, but beneficiaries do. The penalty for missing an RMD is 25% of the amount that you should have taken. And the new rule for qualified charity distributions from IRAs has been increased from $100,000 to $105,000 for starting in 2024. And what that is if you want to have an amount go directly from your IRA to charity in lieu of your RMD, you can do that directly through your financial institution. It can go to any 501c3 charity, and then that amount is not taxable to you for both federal and state purposes. So you can just speak to your financial planner or and then have that money go directly. In 2024, they also had a new rule. It's called the aggregation IRA rule, and that means the first money that comes out of your IRA has to be your RMD before you can do any conversions or anything else. So if you're doing any rollovers or conversions, you have to take your RMD first. So this was something new that was started in 2024, and this was confusing to a lot of people. And this is anybody that has any type of an LLC or an S Corp or a C Corp. So starting in 2024, another department of the government called the FinCEN started a reporting thing called the BOI, or the Beneficial Ownership Information Report. So initially, everybody kind of thought this was just for businesses, but when we started doing them, we were surprised to hear how many people actually had LLCs. So if you have an LLC for a rental or a small business that you have, this was a reporting that started last year. It started in January of 2024, and the reports were due by December 31st of 24. This actually went back and forth all year with it stopped, it started, it stopped and started. The Supreme Court decided yesterday that it was legal to do this, and now they are due. We're still waiting for the actual due date on this because it was pushed back because of all this, but it is considered on again, and these reports are going to be due. So if you have an LLC or an S Corp or a C Corp, they are supposed to be filed, and they do need to be filed. We're still waiting on a due date for that. If you need to know what that is, you can call our office, and if you need to know where to file that, you can call our office. If you need to understand what the FinCEN is, it's a department of the government that handles foreign operations. So that's also where we file the reports for anybody that has a bank account with more than $10,000. So if you have a pension plan or a bank account or any money held outside the U.S., you have to file a a form with your tax return stating that you have that money. It's not taxed, but you do have to file that. And we do have several clients that file those every year. This is the same part of the government that is doing that is now filing this. And all this came kind of from 9/11, has been filing all these reports. Well, this is the same agency. So if you are unsure about this, give our office a call and we can kind of direct you on how to do this, but it is a requirement currently. Michigan also had Act passed, and starting in February of 2025, if you have even one employee, you are now required to pay sick time. So if you have one employee, you're required to pay 40 hours of sick time and allow your employees to take another 32 hours of unpaid sick time. If you have more than 10 employees, you are required to pay 72 hours of sick time. And the way this is accrued is 1 hour of sick time for every 30 hours worked. Employees can carry over unused sick time at the end of the year. You cannot take that away from them. However, if they leave employment, you don't have to pay it out when they leave. So this is currently being argued at the state level, and it could go away, but we don't know that for sure, but it's supposed to start in less than a month. So this is the rest of the state of Michigan information. For the last 2 years, the Michigan tax rate had gone down to 4.5 4.05% for the withholding tax rate. It is back up to 4.25% where it used to be. The personal exemption in 2024 is for $5,600. There is a special exemption of $3,300, and then there's also a qualified disabled vet deduction. The senior interest dividend and capital gain credit is $14,000 for anybody single, and for married it's $28,548. So we have a lot of people that qualify for the property tax credit in Michigan, but there are some limitations on that. Your household income has to be less than $69,701. And just so everybody knows, the household income does include certain things that are not in your taxable income. And an example of that would be your full amount of Social Security, not just your taxable amount. So if only 85% of your Social Security was taxable, the state would take 100% of your Social Security. So another example would be if you get paid child support, it's not taxable for federal purposes, but for state purposes, that would be considered household income. The other issue is your taxable value in your home cannot be more than $160,700. So while you may fall under the income limit, if your house is valued at more than that amount, you are not eligible for it. If you are eligible for it and meet those two criteria, the credit limit is up to $1,800. There is a calculation to see what that amount is actually going to be. If you're over 65, you would get 100% of that. If you're under 65, it's a percentage down based on your age. So a lot of people ask about the home heating credit in Michigan. They hear about it, they want to get it, they bring in their amounts that they pay in heating bills, but the income limits are actually very low on these. So for a single person, your household income has to be below $16,586, and a married person has to be below $22,500. Now, in those income limits, if you have children, it does go up. So single might be $16,586, but if you had 4 kids, that income limit would be higher. Back in 2012, the state of Michigan started phasing out IRAs and pensions not having big tax deductions in the state of Michigan. They started taxing people if they retired early. So if you were under 66, you had to pay on your pension, your IRAs. So in 2023, they started a 4-year phase-in of bringing this back. But instead of making it simple and just bringing it back, they did it over a 4-year period. So this is kind of a table to show you how this is working. So in 2024, you can see at the top, these are the people that were grandfathered into the old system. So the old system would be that if you were born in 1945 or before, there's no changes. You are now over 7, you were in 24, over 77. You're single, you get a $64,040 deduction, or if you're married, you get a $128,080 deduction, and that would be an exemption against all your retirement income, whether it's an annuity, a pension, or IRA. So the next group of people are the people that were born 46 to 58. So they would be in 24, 65 to 77. They get 50% of that amount. And if you can see at the bottom, that would be $30,020 for a single person, $64 and $40 for a married person. That is the same for the next group of people. They also get 50%. The next 2 groups of people get no exemption. So if you were younger than 64, you still get no exemption. Going into 25, it's 75% for the next 3 groups, no exemption if you're under 60. Starting in 26, everybody will get the full exemption amount, and that full exemption amount at the top is raised a little bit every year for inflation. Why they don't use even numbers, I don't know, but they're always a little bit strange, and it's based on a percentage of inflation. That number changes slightly every year. So every year you get a little more of an exemption on your retirement income. And just so you know, Social Security in Michigan is currently not taxed. So just to update you on our office, we used to have a program called Rever, and we used that to allow people to update things, sign electronically. It was a little cumbersome. We have gone to a new software called TaxStone. If you were currently in our system and we had an email address for you, you should have already gotten an invite to that system. If you did not, you can call our office and somebody can walk you through and they can send you an email. But once you sign up, you have access to all your data. A couple of things that have changed this year. I'll skip to the bottom real quick. So every year we kind of get a peer review through our system. And one thing we do have to do this year is we cannot even start on your tax return unless we have a signed engagement letter from you giving us permission to work on your tax return. So if whether you drop off, come in for an appointment, or upload your information into our system, you will need to sign an engagement letter. So if you come in for an appointment, they will have you sign. If you mail your stuff, the girls will either mail you an engagement letter or they'll try to email you or upload that to your system. And the second part of that is your return cannot be e-filed with the IRS in the state of Michigan until you sign the 8879 giving us permission to file your tax return. So at the top of this page, returns are due on April 15th this year. If you file an extension, they're due October 15th. Business returns are due March 17th. And if you do not want a paper copy, please let us know. If you do need anything sent to a bank or a third party, we do need a third party disclosure signed by you, but we can always send it to a bank if you need us to.
All right, very good. Well, thank you very much, Brenda.
You're welcome.
Very, very informative. You know what? Brenda's office has been with our firm as a strategic partner for, goodness gracious, going on 21 years now since the beginning of our company. She's just a great resource, a wealth of information when it comes to the taxes, and does a phenomenal job for our clients. So I want to thank her and her firm and her team for all that they do for Daniel Krug Associates. Let's talk a little bit about the upcoming events. We've got a webinar coming up February 14th. And this is a market webinar, market management review. So stay tuned for that. That'll be actually distributed out to each one of our clients on that Friday, February 14th. We also have our Java workshop coming up. It's markets past and present. And we do have a guest speaker from Dana Investments, Doug Clausen, who is going to be here and speak. So you don't want to miss that one. It really does give you a lot of information about what happened last year and what do we anticipate coming in 2025. And lastly, if you missed any of our events, generally we're recording all of them. So you can go to Daniel Krug Associates YouTube and you can find all the events right there, recorded, and at your leisure, you can watch them. So as we always say, you take care of your family because there's no need to worry. We will take care of you.